I'm Vanessa Stoikov. Welcome to Wicked Problems, Visionary Investors, where we tackle the biggest problems facing the world with experts in the investment community. In the first part of this program, we ask the question, how do we foster global investment when everyone looks after themselves first? Let's take a look.
Today's wicked problem, how do we foster global investment when everyone looks after themselves first? More than ever, protectionism and politics are dictating global investing. So how do we find the right approach to manage risk in a world of deglobalisation?
Today, we'll hear from some leading financial advisors. But first, welcome back to my guests, Amanda Gillespie and Lucas de Porbay. Watching this conversation in our studio is a panel of financial advisors. I'm keen to bring some of them in and see what they make of the discussion. Kim Payne is with them now. Hi, Kim.
Thanks so much, Vanessa. Well, we have been having some amazing conversations with the studio audience. This is really a hot topic because no one's immune from it. We're all living this uncertainty. So just been chatting to Karam Singh, who's the CEO of
Conscious Money.
Conscious Money. And Karam, I was really interested. You deal with a lot of younger clients and often they get forgotten in this conversation because of the world that they're living in right now.
Yeah.
Can you talk about how this plays out and these conversations about global uncertainty in particular are affecting them?
Sure. So what I found with a lot of younger clients recently is that they went through the dot-com bubble, they went through the GFC, the Euro debt crisis, they saw their families going through the whole process, and then they saw the big drops during the early part of COVID, followed by the biggest rally ever. And then you got the rise of crypto, the rise of NFTs and all these tokens around it. So in their mindset, they're going, we've got a cushion job, we've got a good cash flow for most parts, good asset base around it, good experience, the good and the bad. Our behavioral economics behind this has shifted. So my question would be more towards Lucas from Lonsec is around how is Lonsec seeing this shift in the mentality of the younger generation around the behavioral economics aspect, and how would that impact the movement of funds in the future, and where does the industry shift from here?
Yeah, good question. Just before Lucas answers that, I must say the whole behavioural economics is such an important part. And gee, it sounds like the poor millennials, they've had a lot they've had to deal with, haven't they?
Absolutely.
So, yeah, Lucas, what are your thoughts on how this plays out with our younger generation?
Yeah, so the younger generation, I think they have a very different investment time horizon, and as we heard from Karam is, they most of the time, historically, markets have rebounded quite sharply, if you give it enough time. So if you've got a long investment time horizon, that's a very different situation from, for example, if you're just about to retire or you are retired. So absolutely, I think there's different approaches for different segments of the market. The one thing I'd sort of caution is that, for a lot of the younger investors, and depending how young they are, maybe they've only experienced really a bull market, right? So if you think about, GFC,
for sure. It's been 20
absolutely.
good years,
yeah,
really.
Absolutely.
Yeah.
And that's necessarily not a normal market. So yes, you've got a long investment time horizon, and over the long term, we know that markets generally do well. But also, the only thing I'd sort of caution is, volatility is a real thing, and the last 10 years is probably not a normal market environment in terms of volatility.
And I'd be interested to hear from advisors too about if they're seeing, because anecdotally you hear that the younger generation are wanting to connect more with their investments. So whether it's through investments that have more of an ESG bent to them, or even, we're seeing crypto ETFs and products like that coming to market. So is that appealing to the younger generation as well? And I suppose, how do we kind of guide them through that investment decision making?
Well, we've had some interesting sessions on crypto too, and I still don't get it. So
yeah, neither do I.
Okay, good. I'm glad you don't get it. That's good news. Okay, Kim, I hope that's answered the question. It could spark another long conversation with us, but we're ready for the next advisor.
Oh, great. Thanks, Vanessa. So, having another really interesting conversation, and I've managed to get Rob Gilmore from
Well, Simplicity.
Well Simplicity. And Rob, what I'm really interested in is, we're hearing from the panel and the experts who are doing an amazing job navigating all of this uncertainty. But how is this translating to the conversations that you're having directly with your clients?
Yes, well, Kim, part of the challenge is trying to keep things relatively simple for clients in an inherently complex environment. And when they are reading the headlines in the newspapers, high inflation, high interest rates, the performance of the financial markets, and also looking to where residential property looks to be going, there can be a cause of a lot of stress and concern. And so part of the process is to try and put some perspective on where things are in terms of the overall cycle. And what I'd be interested to hear from Amanda is, what does she see as being anything different apart from during the cycle that we're currently going through, and where does she see the opportunities coming off the back end of that, including asset classes like alternatives and residential property?
Awesome. And before we do hand over to Amanda, you did say residential property. Is that something that people are actually talking about? I know we're talking about the global markets. Residential property is still an asset class, so talk to me, is that something that's coming up?
It certainly is coming up, not so much from my clients who are in retirement or just pre-retirement, but certainly for those accumulators. They've seen the returns that residential property has generated over the years, and they're seeing that market is starting to come off and looking for opportunities in that area, so it's definitely part of the conversation.
Yeah, brilliant. Okay, so now, Amanda, over to you for how you're responding to what are you doing differently now that we're in this environment?
So it's a big question, actually, and I think if I kind of look back to what we were talking about earlier, the first thing is it's a very different environment in terms of we don't have all of the tailwinds that we've had for the last decade. So it is about being more nimble and thinking about all of those moving parts. There's not a straight line with any decisions on how to invest. And so it is about, and I know we spoke earlier about having some exposure to some alternatives, or thinking about what that would do in your portfolio. From an equity point of view, and certainly from Perpetual's perspective, I would be saying think about active management in this environment, because there is more opportunity presenting itself, more dispersion, and you need to be investing with looking at stocks and thinking, how is that stock going to be impacted by the macro environment, but actually looking at it in quite a granular way. The question on property is an interesting one. I mean, I know we've been having conversations, our investment teams, around the valuations. You're seeing a lot of kind of the property sector is very is extremely has come off a lot. When is it an opportunity to invest again? And so I think to Lucas's comment earlier, you've got to take. If you're taking a long-term view, at some point, obviously, if you're investing now, that will kind of, in the long term, ideally be beneficial. But probably my last comment would be, it is very difficult to pick the turning point in markets, and perhaps. I think that point about having simple conversations with clients is really important, but perhaps don't try and pick the turning point. Be talking about how hard that is to do, and how it's better to have a range of different assets and investment styles in your portfolio. So
Okay.
a long-winded answer. It's a difficult question to answer. In fact, in terms of unfortunately I don't have that crystal ball. So when the crystal ball's a bit murky, I do think you need to have a few different options in your portfolio.
Yeah, it sounds sensible to me. Very sensible. Okay, Kim, our next advisor. What's the next comment from our advisor?
Great, thanks, Vanessa. So we are still having some really interesting conversations, and now I've got Renee Condalis from Perpetual here. And one of the things that we've been talking about that's fascinating is, how does all of this global uncertainty affect your clients from a strategic point of view, in particular the bigger picture plans that you're putting together for their financial futures?
Yeah, totally. So I guess how I would describe the aspect of putting the financial plan together is really at the early stages of establishing the relationship with the client. So the strategy is more aligned to the client's needs and goals. Yes, financial markets and investments are a big part of that, but really the focus is around what the time horizon is and what is it they're ultimately trying to achieve. So in uncertain markets, conversations, clients definitely expect to be kept briefed and informed, and particularly, how their portfolio is moving around as a result of volatility. However, when we look at the broader or greater strategy of a client, that comes down to more what they're planning for their future. What sort of financial event is going to occur that we have to then adjust the strategic plan.
And are you finding any of their needs are changing as a result of the uncertainty? So the conversations are about what's going on in their lives?
Look, I think what comes more in focus is probably cash flow. If we think about retirees that are funding their retirement through their investment portfolios, income becomes a bit of a focus if yields start to get squeezed. So yes, we do definitely consider that, how they're positioned in terms of the income that they need to achieve, through retirement or if they're in accumulation phase. But that all comes back down to the overall construction of the greater portfolio.
Great, which tends to be quite consistent as long as you're managing it. Gee, I tell you, it certainly makes a great case for having a qualified financial advisor on your case, doesn't it? Yeah, absolutely. So if you could ask one question for one of our panel experts, what would it be?
Yeah, look, part of our job as a financial advisor is picking the right investments, for our clients. But in terms of the options that we have as advisors, through platforms, I would want to understand, particularly in this current market where companies are being challenged, and investment funds are being challenged. How asset managers, how are fund managers, how are you doing your due diligence to pick the right investments?
And who do you think is going to be best positioned to answer this question for you?
Position that to Amanda.
Amanda. Yeah. Okay, Amanda, this one's back to you again. Thank you.
Great question. So I think the short answer is lots of hard work. So I think in terms of the due diligence, it's having, and the way we look at investing in equities is through, a lot of experienced analysts within the team, spending lots of time doing, deep kind of inquisitive research on every company that we invest in, as well as those we might invest in. And I suppose that the short answer is there's no substitute for deep research and doing the hard work. And I suppose challenging yourself to think differently to everybody else about what are we missing, or what's the market missing, and really asking those probing questions. And I think that's probably
a good answer. Do the work. I hear you, Lucas. What would you be telling advisors who are going, okay, we're in a transition period, I've got clients asking me questions, and the platform, I guess you use what products on your platform, but what would you be saying to advisors at this point when they're talking to their clients?
Yeah, I think the comment around having, sticking to your long-term strategy as well, because you may have, hopefully you've got a diversified portfolio. Yes, one fund maybe is underperformed, but you maybe have another one that's done okay. I think this isn't the time, when you have a period of transition, it's not the time just to flip-flop and sort of do reactive, say, selling because something's underperformed. Sometimes things can underperform, or a fund can underperform for a very specific reason. Maybe it's just a function of the market environment in a short period of time. So it is about then digging deeper and understanding what's driving their performance. Why have they underperformed? Is it because they've picked bad stocks, or is it simply because the market is just against them in this environment, and therefore actually you shouldn't maybe crystallise those losses, because at some point those returns will come back. So further to Amanda's comment, it is about doing your due diligence and digging deeper to understand what the drivers are, rather than just sort of looking at the absolute performance number, over 6 months and saying, well, they've underperformed, let's get out of them, or
Yep.
whatever it may be.
Okay.
And each investment plays a different role, or can play a different role in the portfolio. So they won't all be, from a broader perspective, may not all be performing at the same time.
Okay. Well, again, no easy answers, is there? There never
Unfortunately
is
not.
when it comes to wicked problems. But that's why we're here. Kim, let's hear from our next advisor.
Thanks, Vanessa. And continuing on the question around portfolio construction, I've got Aziz Meherali from Elixir Private Wealth here to give me your views on, with all of this uncertainty, what impact is it having on your portfolio construction with your clients?
Okay. So we tend to look after high net worth clients, and we've had the same clients for 20 plus years. So we like to think that we've trained them in terms of all of this market volatility. We've lived through the GFC, we've lived through the COVID correction, etc. So from our perspective, we do actually have a fairly large allocation to alternates. And obviously within that space, we also think of infrastructure, for example, as alternates because it's staple income. So regardless of the market volatility, there's a steady income coming in. Because from our clients' perspective, it's the income that's generated from the portfolio that they live off. So the volatility in terms of capital, hopefully we've trained them well enough over the years to understand that that's fleeting and goes down and goes back up, so it's not a concern. So from our perspective, the concerns we have at the moment in terms of having that asset allocation and construction is the Aussie dollar is so weak. And most of the infrastructure assets, most of the good private equity and alternate assets are priced in US dollars. So for us, it's now increasingly expensive to purchase. And if we believe that the currency is going to revert back to mean, let's say 75 cents, for example, in 2 years or 3 years, we potentially have a loss on our hands. So that's the concern from our perspective. So I think that my question to probably both Amanda and Lucas would be, and by the way, we use Lonsec as an external house for our research anyways, but the question would be, how do you circumvent the currency impact in terms of portfolio construction, especially in light of the volatility?
Yeah, beautiful. So Amanda or Lucas, how do you really look at the impact of currency fluctuations when you're constructing the portfolios and doing the work that you're doing?
Yeah, so currency is a really hard one to pick in terms of trying to pick the inflection points in terms of currency. But we do look at, I guess, if currency is trading at extremes, and then at what point do you maybe start adding some hedging in? At what point do you take some hedging off? So we're not trying to pick inflection points. It's really sort of that if there's an extreme divergent sort of pricing anomaly in terms of currency, then we might look at more hedging. But at the moment, what we are seeing is obviously the main issue is that the US dollar is just strengthening so much, and then so it's more around the strength of the US dollar rather than the weakness of the Aussie dollar, which is what part of that is obviously the inflationary environment and what the Fed has been doing in the US, which has put pressure on our dollar. But certainly in terms of what for investors then investing offshore or buying offshore assets directly, then they are more expensive. But in this environment, probably over the next sort of 6 months, this sort of environment will likely to continue in terms of that US dollar strength. But then beyond that, we might start to see some normalisation in terms of the Aussie dollar rising.
All right.
And I suppose that it does, we've talked about it creating opportunity as well. So, I mean, I think, correct me if I'm wrong, but I'm Lucas, but I'm pretty sure that unhedged, if you were invested in unhedged global equities over the last quarter to 6 months, you've actually done a lot better than otherwise, if you hadn't been unhedged. So you can actually benefit from, fluctuations depending on what your hedging strategy is. So I suppose, again, it's back to that, the discussion about having some diversification of your exposure to currency as well.
Okay. Well, look, I suspect that this audience could ask questions all night, and I really appreciate both of you spending your time with us to talk about it. There's so much more I want to say, but we're going to have to leave it till the next episode. So thanks so much to Amanda and Lucas for leading us in the conversation, and a special thanks to our studio audience. That's all for this episode. I'm Vanessa Stoikov, and remember to stay curious.
Thank you.